What's going on, everybody? We are back with another episode of the Wealth for the Culture show. This week, it's going to be, this should be a good one. I've been kind of procrastinating doing this. And since I had to reschedule all of my guests for the week, I figured this was a good time to go ahead and address the 10 stock commandment.
1, 2, 3, 4, 5, 6, 7, 8, 9.
It's the 10 crack commandments.
No pun intended. Kind of just to play off, Biggie. Biggie got the 10 crack commandments. I figured, hey, let me come out with the 10 stock commandments, man, because a lot of people are trying to get into the stock game, and a lot of people are asking me questions. And I feel like this is a good follow-up episode from the one I did about a few months ago with my boy Zay, where we kind of just broke down stock investing 101. So now, I just want to kind of, reach back out and kind of touch back on this, but with a different twist. Kind of give you all some guidelines per se to follow. This is what I follow. And, before we get started, just want to let everybody know, I'm not a financial advisor, not a fiduciary. This is just, all these tips are, it's just for educational purposes, information that, I feel is helpful, stuff that I use personally. I'm never going to try to steer you the wrong way and give you something that I personally am not taking part in and utilizing myself. So, just want to, get that out there, break it down a little bit for y'all and give y'all just a couple stock commandments that, can help you out, allow you to, take advantage of investing and the power that comes with investing in the stock market. This really, I was gonna make a rap out of it. I try. I can't do it. I can't make up stuff that can rhyme and all of that. But basically, I just want to give y'all, a step-by-step booklet. Get y'all's portfolio on track. Really, so this market start smacking us, start smacking everybody, and get y'all on the right path. On the path to building wealth and creating for those that come after you. So we'll just go ahead and get right into it. As I said, I'm not a financial advisor, but we'll just go, rule number one. As far as, I'll say this, don't invest what you don't have. Some people will say, invest 70%, live off 30. I know that's not possible for everybody, but you have to start somewhere. Work your way down to that if you can. Anything you can't afford to lose, don't put it in the market. If you don't have it, just work to build up to get something to start contributing into the market. It ain't worth it trying to survive. It ain't worth it if you can't survive, trying to chase the bag. And more importantly, we need to start thinking about using cash as a tool. So this will give you, for one, this will put you on a nice journey to start understanding how to break down your budget, break down your expenses, see where you can cut back. If you want to increase the income, that's a possibility too, because I've had people come on, talk about debt and stuff like that and debt elimination, but also ways to increase your income so that you could do more things and have, more utilization and more purchase power and stuff like that to be able to, take avenues of investing or whatever. So I would just say this is rule number one. Biggie say rule number uno, just don't invest what you don't have. And that's probably the biggest thing that I think anybody that listens to this needs to take away. You don't have it, don't invest it. If you can't afford to lose it, that means you don't have it. So don't invest what you can't afford to lose. Number two, have a plan. A lot of times this goes over a lot of people's heads. People think that, let me just jump in. Well, no, you need to have a plan, because if you don't have a plan, just speaking from prior experience, everybody thinks they have a plan until you get hit in the mouth. That's what they say. But what I will say is having a plan going into the stock market, it'll keep you from losing a lot of money. Some people, they'll be more, long term. Some people are short term. Understand this. Let me get this out here as well. Understand there is a difference between an investor and a trader. Investor is more long term. Trading is more of a short term thing. I mean, you can do a combination of both. It's just it goes back to knowing yourself. A lot of people that I talk to, they're describing what they want to do, and it's more along the lines of trading. But understand that they say about 95% of traders lose. They don't make money. So you're in this game to make money. And I think that's some key that people need to understand and need to take away from this. Like, we're in this game to make money. We're not in this game to, mess around. We're not in this game to just be playing around. At the end of the day, the name of the game is make a profit. Just like anything else, you're selling something, you buying something, you buying something to sell it, then you're buying it with the intent, or you're putting in an investment, you're expecting a return on that investment. So that's what you need to keep in mind. So rule number 3, don't be dependent on nobody. Do your own research. Understand people love to, sit out here and they all capping and stuff. And, a lot of these people, they'll follow the wave. Recently, we've seen the whole wave with the GameStop and the AMC. And if you did make money, kudos to you. That's great. You had a plan. That's what that tells me. If you did make money on the GameStop, most of y'all that got in, got out, y'all had a plan. We'll go a little bit deeper in what in a couple stuff. We'll talk about plans and stuff like that. But at the end of the day, I say, let me just take a step back to number 2. When I say have a plan, I necessarily mean understanding what you're trying to do with the market, right? We get into the market, we have different ideas. Some people just want to have something that's slow growth. Some people are more risk averse. Some people, they don't care about the risk. Like, I'm one of those people. I like the Tesla stuff that's super volatile. Some people want to be more safe. Some people like you have options like index funds and ETFs, and if you want to take that route, which is a little bit more safe because it minimizes the risk. And, just real quick, index funds is more based, stuff like the SPY, which is kind of based off the S&P 500, different things of that nature. ETFs, just real quick, we broke it down if you haven't seen the previous episode. ETFs is, exchange traded funds. Those are more sector specific, like chip ETFs, energy, tech, consumer discretionary, things of that nature. So if you want to go that route, it kind of lessens the curve of having to do a lot of heavy research, So, that's something to take in account. I would say, I'm good to look at. A little bit of going back to, we're going forward, rule number 3. When I say do your own research, I say this because a lot of people out there, as mentioned, they're just jumping on the next wave. They're just trying to jump on the next thing that they think is going to get them rich quick. And while you can make money in this game, what you need to understand is it's not a get rich quick thing. This is more of a skill to me. Investing is a skill. Especially if you're trading. If you're trading, that's a skill. Investing, you can fairly be really safe with this and make money. You want to go that extra mile and really start digging deep into every single company. That's where this whole do your own research comes into play, because you need to invest in not only invest in what you like, because sometimes what you like, it may not be something that's making out there that's doing well or performing well in the market. Company may not be good. You may just be a fan of it. So you understand the difference between you liking the company, understanding it, and understanding how it makes money. And you also need to understand that some companies, they're just not good. When I say do your own research, you have fundamentals. You do technical analysis. That helps as well to kind of come up with a solid plan, per se. But really doing your research goes into understanding the company and, knowing the fundamentals and being able to, differentiate what makes this company good versus, what makes this company bad. And it's, kind of, what it'll do is it'll help weed out a lot of the stuff that'll waste your time that you don't even need to be considering at all. So that's why I always say, do your own research, because a lot of times we start doing research on these companies and digging a little bit deeper, you'll figure out that a lot of this stuff isn't reputable, isn't a good company, isn't a good play at all. So that's just kind of one of the things I'll say that needs to be taken into account. So far as, rule number 4, I need people to understand this and understand this good, because a lot of times, especially my investors, understand that time in the market beats timing the market. Nobody can time the market. Nobody's gonna make the perfect. Nobody can time the market perfectly. We don't. If that was the case, everybody would be rich. We'd all be millionaires. We wouldn't even it would be no point. So understand that time in the market beats time in the market, because a lot of times what happens is when I say create a plan, do your own research. Well, what will happen? You'll get caught in analysis paralysis because you're trying to find that perfect inch. You're trying to find you start information overload, right? So understand time in the market beats time in the market. Once you've done your research, take that first step and get in the market. Go execute, because at the end of the day, now you have this thing called time on your side. And as we see it, we look at historic data. You know, any good company that you invest in over a 10-year span is the returns are astronomical. It's crazy. So what I always tell people is, just get started, get in the market, because a lot of times, we'll get caught up in, rule number 2 and 3 with the having a plan, doing your own research, and then we'll forget to even execute. So now if you never executed, then what is this? Just like entertainment for you. You have to put some type of skin in the game. And again, if you're following these rules, you're not investing what you don't have to invest. You have a plan. You've done the research. So now go ahead and get in the market so that you can let that time start taking place and helping you out. Most times, what I'll tell people is, if you're not trying to get into a stock, if you can't see yourself in that stock for about 5 years, 10 years, long term, then it may not be for you. But again, that goes back to your plan, because you may just be in a play for a short amount of time, because this might be like a leverage type deal where you just want to build up some type of capital, and it might just be a short term thing. But because you've had that plan, you understand that. So, number 5, this one is probably one of the most important things. You need to have an entry and an exit plan. I say this because just because you think something is reputable, just because you think a company is a good move, a good play, something that's a good investment, things happen over time, things change, anything can happen. We see companies all the time. Like, look at Blockbuster, one of the top was what we think is a good company, and they didn't adjust with the times, and eventually got phased out. So understand, this entry, you could have you do your research, you could have it set to where you want to get in at this price, or you might just want to wait till you see it might be at an all-time high, but it's going to keep going up. You might have done technical analysis. You might see that it's due for a pullback. And I mean, you might see it come pull back 3 to 5%, and boom, that's a good enough chance to get in. But also, as more importantly to me, is having an exit plan more so than an entry. If you're long term, the entry, we will say, doesn't necessarily matter if the company is something that you deem to be good. So what I'll say is, having a exit plan is the real thing, right? Sometimes you may go into a company, thinking I'm gonna hold this company forever and I'm gonna pass to my kids, but you may also go into a play thinking, oh, I want to hold this. When it doubles, I'm going to get out. A lot of people that do like the penny stock stuff, they may have the intent of, oh, I'll let this run up, 5x or 500%. And once it hits that point, I'm gonna get out and I'm gonna take that money that I built up with this, and I'll go put it into a long-term play. So just understand having an entry and exit, and also don't depend on someone else to give you a play. Everything I'm gonna say is gonna tie in all the rules. This goes back to doing your own research, stuff like that. And don't get me wrong, if somebody gives you a play, that's fine. But what I'll say is go look into that a little bit further. I've got players from my boys. People have gotten players from me. But most people that I give plays to, and vice versa, we'll go do a little bit deeper digging on that play and understand, well, hey, this may happen with this. Okay, I know this, this is a catalyst for why this might increase in price. This may be something that'll hinder this, and it'll be a reason, this will be why it might drop. So I just want people to understand that and get that into your head. Like, yeah, it's fine to take a play with somebody, but have your own entry and exit, more importantly, plan, and just don't be dependent on the next person. Because what happens when you're just all alone doing this and you haven't done any of the homework, you haven't built up a plan, so you don't even know where to start. So now you're all over the place. And as more importantly, when you don't have an entry and exit plan, you don't know when to get out. because a lot of people, we'll talk about it later, but a lot of people get caught with the head in the cookie jar trying to, follow a wave. And you don't understand that person that gave that play might have been in that play for months, years, or at, a price that's half of what you're about to pay for. So that's why you have to understand, like, planning your entry and your exit is very important. And, this one, I'll say number 6, man, rule number 6. It's like Big said, a goddamn credit debit. Margin, people. We don't mess around with margin. That is, strict. He said consignment strict for live men, not for freshmen. I'll say this: margin, just don't mess with it. A lot of people don't understand. There's more so almost working with credit, and we've seen people, in the news that have killed themselves, committed suicide because they tried to mess around margin and put themselves in a deep hole that they knew they couldn't recover from. And then next thing you know, you see a news line saying, a young person commits suicide because of they went into, 6 figures worth of debt that they knew they couldn't cover. So I always say, look into, just invest what you have to invest. It all ties back in. You don't have it, don't deal with it. That credit, that's for skilled human beings that know what they're doing. And when you're just getting started, you don't need to be looking into that realm of things anyways. My Forex people that want to get into this, a lot of people I've been in that community, they trade on margin. I personally just don't recommend it when it comes to this because you can really mess yourself up. So margin, don't deal with it. Some people may suggest it, but that's a little bit, to me, that's a way more advanced level. I've done it. I've dealt with it. I mean, you can be successful at it, but as far as most people that listen to this are probably just getting started, I want to get on that journey. Margin is just something that I tell people, just do not mess around with it at all. Number 7, this one ties in well with, doing your research. You need to understand the fundamentals. Fundamentals, basically what the company does, looking at the books. Because at the end of the day, what you're looking for in a company is this company profitable? It's a business at the end of the day. And the key thing with business is you want them to make money. I mean, that doesn't necessarily mean that some companies, maybe like the tech companies, they may be looking to like innovate and look for that next big thing that'll help them out, that'll put them ahead of the pack. You have like AMDs that are, slowly rising to the top. You have people like Nvidia that's already at the top. You have people like Apple's that are at the top of the top, and they're constantly looking to innovate. You have people like Amazon that are, constantly just looking to disrupt the industry. So understand the fundamentals. Make sure this company has a moat. When we say a moat, just it's something that keeps it ahead of the pack and doesn't allow competition to come and deter it off of that. Looking at the financials, you can look at that on most companies' websites. Also, what I'll say is you need to make. We talk about research, and you need to make. I talk about having a case of what makes it go up and down. So we'll have a bear and a bull case. A bear case is going to be something that's going to drive that price down, that's going to drive the value of that company down. A bull case is going to be catalyst that's going to affect it positively, that's going to increase the price. So when I say make a bear and a bull case, even if it's the company you really love, you need to understand that with good comes bad. So you need to understand what are going to be some things that are going to make it do a 180 and could go against you, because then this ties back into understanding, your entry and exit plan. If it does this, if it takes this turn, well, okay, it took this turn, so let me go ahead and look at it this way, and I potentially may be looking to get out. Or you may have got a run up and you already looked at that because you understand the fundamentals. You know the catalyst that's taking place. You know what's coming to boost that stock, right? So to me, the key thing is, understanding the fundamentals, especially when you start looking at individual companies more so than the ETFs and working around the indexes and stuff. Just simple research. It doesn't have to be complicated. If you want to go look at all the analyst reports or anything like that and see what other people are even getting into, you can go to Zacks. You can go Seeking Alpha is one I use. Bloomberg. You can turn on CNBC. CNBC is a great resource for people that just want to wake up. You can turn that on in the morning. You can go look at I obviously use Bloomberg to find out stuff. I like Twitter. Twitter is a good community. I like Reddit even. Uh, if you want to go look at the actual website of the company, kind of just dig into their financials and their balance sheets and stuff like that. Looking at like earnings per share, their PE ratio, which is the price. Oh shoot, PE ratio. And a lot of times people will say, back in the day, people say like 25, I believe, and lower is a good PE ratio. But I mean, in this time, the market is crazy. So I mean, more so, I don't necessarily focus too much on PE because you might not get in the companies that you actually like, and sometimes that doesn't really necessarily matter because the company might still be growing, et cetera, et cetera. Also, I like looking at companies, how much cash they have on hand. A company like Apple, who has over hundred billions of dollars of cash on hand, that anytime they can make a move. Constantly looking to innovate, or constantly looking to disrupt other sectors, or get into different industries. Like you have Apple now; they're trying to make a play into the EV market and make an electric vehicle. So we'll see how that goes. Looking at, we'll just use Apple as they have a moat because all their products, the services they offer. They got Apple CarPlay in most cars that you come in contact with. They have their whole ecosystem of products. It's not just a one product thing with Apple. Most of the time they have cult followers. Like let's say, you get an Apple iPhone, right? You're gonna end up getting a watch. Then you'll end up getting an iPad. Then you'll end up with a MacBook. You might end up with, the Beats or the AirPods, iHome. It's just a whole ecosystem of products that all work well together. So that's why, I say understanding the fundamentals of a company is so key and so important, right? So we'll move on to rule number 8, which this one, I believe it is pretty underrated. A lot of people fear the dip, right? I see a dip in the market. Most people see a dip in the market. They see a drop in the market. They get nervous, they panic, and they sell out. While they get nervous, they see a dip and panic. I see a dip and I see opportunity. It's the same thing, for our day-to-day people. Like, we'll just go with people that like, if you like J's. If I told you get some Jordans for 70% off, legit, not fake, real J's, you can get them for 30, at a 30%, price compared to the 100%, you're getting a 70% discount. You probably gonna take advantage of that. If I tell, a girl she can go get, a Birkin or something like one of them bags, you're paying $1,000 for. I can tell you get it for $100 and it's real. You're gonna take advantage of that. When we see sales on certain things, we're so quick to go jump on it. But when we see a sale, when the market drops, that's presenting a sale opportunity to you. And honestly, if you already have stock, a method that you could take is dollar cost averaging, which is essentially just, you could buy on the dips, you could buy as the stock goes up, but what it'll do is as you buy more, you'll buy it at different prices. And what that does is your average cost per share will decrease. So as the stock grows, you lower your average cost per share because you're constantly buying. You might be buying every time you see a 3% pullback. So now you're making, you're lowering that cost per share, but as that price increases, you'll see better returns. So that's what I like to tell people: don't fear the dip. Most if we look in past history, I can't remember the exact days, but every time we have a correction or a pullback, we go reach new all-time highs. It's just the history of the market. If you go look over the whole course of the market, there's never a time where we just go into bear market territory where that will be the price going into a drop that we don't recover from, which ties back in rule number 4, which is time in the market beats time in the market. So don't fear the dip. Take it as an opportunity to, make moves, make plays. Now, if you've planned your entry and exit, as we spoke about earlier, when you see that dip in the market, okay, I see the 3% pullback. I see a 5%, 6% pullback. Okay, boom, now I can strike. I can go make my entry into this. And then you can ride the wave up over time. So number 9, this one to me is one that people really need to take into consideration. Cut losses early. Don't be greedy. A lot of us, what we'll do is we'll have a whole plan built up. what we'll do is we'll let greed get to us. And we may have said, okay, this gets to 300%, I'm going to cut my losses. Okay, so, I mean, it gets to 300% gain. I'll just go ahead and cut it, take profit, right? And what happens is we'll be thinking like, oh, no, it'll, forget it. It's going to run up to 1,000%. Knowing it's probably not. But, this will go to the last rule later on. I'll get to that. But, what really is important is you have to cut losses early, right? That to me is rule number 9. Being able to cut losses early. A lot of us like to have that hope, and we'll start, just like TLC said, man, don't go chasing waterfalls. Don't try to catch no falling knives. Like if a company is going down, and it's not just something like if it's down, you might have a exit plan of like I'm willing to take a 30% hit on this. Well, you have to stick to your rules, stick to the script. If you made this plan in your head, you've written this stuff down and have a set plan, then I would just say once you get to that exit plan, if it does in fact come to fruition, get out. Because you've been doing research and you followed all these rules, you have another play in place. You have, when you start talking about cut loss early, what I'll say is when you make a plan and everything, and when we're doing our research, right, what you need to understand is having a pivot, right? Have some place to pivot to. Let me go back to the have a place to pivot to. If something doesn't look right or something doesn't go your way, you need to understand that, okay, well, let me take a pivot to this. I might be in, Google, and let's say Google just takes a hit, out of nowhere. Well, my pivot was to go to Apple, maybe, and you have your reasons for going to Apple. So have another company in place where you enter or get into a company, which for most of us, if you're long term, you're going to be constantly doing research anyway. So you'll have numerous plays, right? So all I'll say is this: cut losses early, have a pivot plan, and don't chase waterfalls, man. Once that thing is going to a point where it just looks like it's a point of no return, you've got your exit plan, get out. Don't hesitate to get out. Everybody takes losses. The name of the game is make money, but you have to understand, to make money, you can't sit in something that's just going to keep on dying. You got to get out. What separates people is the people that get out early and see that loss and go find that pivot that'll help them to recover and then go on to get back into profit, right? Number 10, this rule, most important rule, this is the key thing. Take emotion out of the market. Hope does not live here. Can't keep saying, oh, I hope it'll come back up or it's going to make it'll bounce back. Yeah, it may very well bounce back. But what the market doesn't care about is your feelings. It does not care about your emotions. It don't care. It will eat you up and spit you out because at the end of the day, we are retail money. We are not the millionaires and the billionaires. We're not the big hedge funds. We don't move the market, right? We don't move the market. So what I need people to understand is you have to eliminate emotions when you get into this market. Because I'm telling you, a lot, we've seen it. People have the hope when they get into, when they got into the GameStop play. A lot of people had that hope getting in the 400s that, it's going to keep running. It's going to keep running because they just been going off of the hype. They haven't done any research. They don't even have a reasoning to getting into this play. So now they're living off that emotion and they're watching it slowly tank, dropping 20%, 30%, 40%, 50%. It dropped down back to, the 50% area. I mean, it's back up a little bit. But those people that bought at 400, living off that hope, you've taken a significant loss and you could have cut your losses early, got into a pivot play, and been just fine. And honestly, had you done your research, you would have understood that wasn't the play for you anyways, especially at that point, and you would have never got into it at all. So this is, like I said, everything ties in together. But, just to recap it, I'll recap all these rules, the 10 stock commandments. I just want to, just go ahead and recap real quick, right? So 1, don't invest what you don't have. Rule number 2, always have a plan. Know your pivots, all of that. Rule number 3, don't be dependent on nobody. Do your own research. Number 4, understand time in the market beats timing the market. Number 5, have an entry and exit plan. I believe exit plan is more important, but hey, to each its own. Number 6, remember that goddamn credit, debt it. We don't mess with margin. Don't mess with margin. Number 7, understand the fundamentals. Build that bear and bull case for the company of why you should invest in it. Number 8, don't fear the dip. It's okay to buy the dip. When you see a dip, hey, take advantage of that opportunity. That's a sale right there for you. It's a buying opportunity. Everybody begs for discounts, begs for the market to pull back, and then it pulls back and everybody's scared. Number 9, cut losses early. Cut losses early. Don't go chasing waterfalls. And number 10, no emotions. Eliminate emotions when you come into the stock market. Just get that out of your system. We don't take emotions into the stock market because it'll make you make a stupid play and you'll lose a lot of money. I just want to thank y'all for tuning in again. I appreciate y'all. It's been a while since I've been able to do an episode by myself, so this is actually pretty good, especially with everything going on with the stock market. And that's where I'm kind of, that's my niche per se. I like stocks. I like investing in that stocks and crypto. Y'all know, anybody that knows me knows that's pretty much all I talk about. One thing I will be starting to do my small account challenge coming in March. I believe I'll probably start that the 3rd week of March. I'm just still trying to get stuff together. I'm trying to get a desktop computer and stuff set up in my house because I want to have a nice legit setup. I'm kind of tired of doing all my stuff and my trading and stuff on my laptop. It's kind of annoying. So yeah, I'll be starting with I'm thinking I'm gonna start with $1,000, maybe a little bit more. I don't know yet. Haven't made up my mind, but for right now, I'm gonna say I'm gonna start with $1,000. I'm going around the ideas of potentially doing penny stocks, weekly options, which these may or may not happen. I'm definitely gonna be getting back into my SPAC bag, and we'll just see how that goes. I mean, the goal is to let y'all follow me on the journey. This is gonna be all just straight trading type deals. It's not. This isn't a long-term investment type thing. For instance, I have my own separate accounts for that. This is more so just bring y'all on the journey. I'll definitely be heavy on my technical analysis, and I just kind of want to document this so people can follow along, and just understand that it is possible to make money, but it's also possible to lose money, and you'll get to see the good and the bad. You're going to see my plans of how I decide to pivot to the next thing if something doesn't go my way. Also, understanding that patience is a big key too. You have to be patient. A lot of this stuff is not the glitz and glamour that you think it is. Sometimes you just have to be patient, wait for that perfect move that you believe is perfect move. Because you're never gonna pick the perfect move, but your technical analysis and your fundamental research and all that, that's gonna lead you to the best play. So, I just want to invite everybody to come join me on the journey, or everybody that wants to join in that's relatively familiar with trading. Hey, I'm just trying to build a community of people that are investing. It could be stock market, real estate. I don't care. I'm just trying to build a whole community atmosphere where everybody can get together. We can talk about all things investing. So that's what I'll be working on. Wealth for the culture. Slowly but surely, we're getting things rolling with that. I got a couple more business moves I'll be making that I'll be kind of revealing to y'all soon to come watch the journey of all of that take place and unfold. But other than that, I appreciate y'all for tuning in, man. Another episode in the books. I can't disappoint, every Saturday, I might change the drop date soon and make it on a weekday since most of y'all seem to listen during the week anyways. I do have a new theme song coming soon. We'll probably be eliminating weekly artists for right now because they took down one of my episodes. So I went and took all the music off all my episodes. For right now, if you are an independent artist, if you want to, shoot me an email, leebrady77@yahoo.com. Shoot me an email with your music, man, and I might put it on the show if I rock with it. Just try to help somebody get their name out there. Once again, I love all y'all, man. Appreciate y'all for tuning in every week. Wealth family couldn't ask something better, man. Let's just go get this money, build this wealth together, man, one step at a time. Thank y'all for tuning in, man. I'm out.